It's the report we've been waiting for from Walmart. Reported earnings this morning, up 3.7%. Pre-market over 130 a share right now. I was expecting some quite intense numbers from this company, and I will definitely take a look at this real quick. We'll analyze this and look at their presentation and see what they have going for us. And I need to say that I am absolutely shocked by how great this report is. Just 100%. Now, if you think about this for a second, both a non-GAAP beat of 9 cents, $1.18 per share, and a GAAP beat of 33 cents, $1.40 per share. That is the line that shocks me so much about this. So you typically would expect to see in this type of environment, companies probably getting hit a little bit harder on that. That EPS line is the one that's going to struggle. There's many reasons for it. You think about a company like Walmart, the amount of initiatives they have to take in this current time is insane. The amount of money they have to spend just to, take care of both their associates and customers is quite intense. We're talking about an expedited bonus that they gave out, their quarterly bonus, they expedited it, paid that out early. So there'd be 2 bonus payouts they had to give this quarter. They gave an additional hazard pay bonus this quarter to everyone that works for them. They went ahead and they're providing ridiculous amounts of face masks. We're talking about so much sanitizer they're buying for their stores. It's insane. The amount of costs that have really been accrued because of this if you're a retail store. Really any place right now. There's just so many costs associated with it, just having people come to work. And they're spending a lot on their associate benefits really right now. So to see an EPS beat that big is very nice. I mean, that's very profitable. It's ridiculous. That's a lot of money being brought home by this company. And, biggest and baddest retailer in the world, what do you expect? And that revenue line's ridiculous. $134.62 billion plus 8.7% year over year, beat by $3.7 billion. You don't see those numbers every day. I mean, could you imagine growing at a rate of 8% when you're already making $130 billion? That is ridiculous. That is a ridiculous beat. That's crazy. And we talk about, obviously, the demand wasn't there. People are always saying that the demand's dying down. And I work for a retail company, and I can promise you, I don't think the demand's dying down that much. So this is something that I think will continue, all things considered. And not only that, maybe in-store the demand might decline a little bit, but the online momentum is where it's at. This company is just rocking it. And I think you can see it here. So e-commerce sales soared 74%, and my prediction was 50%, right? I thought they'd grow 50% this quarter. Son of a gun. 74%. That is ridiculous. Very nice beat in terms of that expectations. This is something they've been growing 30% consistently, and to see a 74% number is pretty massive. So, 10% comp sales led by food, consumables, health, and wellness, and some general merchandise categories. Obviously, not clothing. Those things. Really, most of it's probably going to be outdoor, seasonal type items. Average ticket price were up 16.5% during the quarter. Holy crap. People are hoard buying a lot. There's no doubt. People were hoarding. International sales up 30.4%. Sam's Club sales increased 9.6%. Son of a gun. See Sam's Club sales boost like that when Costco has really had problems, right? And you see Sam's Club actually posting really good numbers. It's interesting to see. And I think a lot of it is probably because of Costco's mandatory mask policy. A lot of people are turning away from Costco for the time being because they don't want to have, if you're a customer there, not everyone wants to wear a mask, right? Trust me, I can tell you, I work with the public, maybe 50% of the people wear masks, probably less than 50%, so, and a lot of those people don't want to wear masks, so that's where Costco's losing out. Gross profit rate declined 66 basis points. Not a shocker. Not a shocker at all. So Walmart withdraws guidance. While the short-term environment will be challenging, We're positioning well for long-term success in an increasingly omni world. Pretty wild. Yeah, I mean that's crazy. You could definitely think about it. There's a lot of good things coming on for this company. One other thing that they announced too, Walmart is discontinuing Jet.com to the strength of Walmart.com brand, obviously. So they're just going to keep going all under Walmart.com and not go with this different name with Jet.com. They're a separate company. So very nice, very nice. So yeah, special cash bonuses of $755 million were paid out to hourly associates. That's nearly $1 billion they paid out. Son of a gun. And they generated a cash flow of 5.3 billion in the quarter. Son of a gun. Let's look at these earnings slides and see what good things we have. Obviously, one main point here too. You can see the hiring of more associates, 235,000. They hired a lot of people, and they needed it with the pent-up demand, right? And I know there's a process of, still hiring right now. And it's a little bit different. They're working on hiring temporary associates, which is pretty cool, to hire temporary people that don't necessarily have to stick around and you don't have to pay benefits for. So it's not a bad idea, all things considered. But just looking at the numbers here from total revenue, stuff like that. Let's take a look here to see that difference. Change year over year of around 10.7 billion, 10.7 billion more dollars in sales. That's insane. More revenue. Gosh darn. Membership and other income, you saw a decline around 2.7%. But meanwhile, in the quarter, you see EPS rose 5.3%, changed around 7 cents. An EPS gain year over year is pretty massive to think about in the given times. But obviously, next quarter, I think you'll see a bigger EPS hit. I think it's fair to say. Gross profit rate fell. Effective tax rate rose a little bit. Return on assets, good 6.6%. Nothing bad there. So that's a consolidated little balance sheet thing. One thing cool, I don't know, they're showing the picture of it, but I don't know if they'll mention it here, but this concierge service that they're offering at Sam's Club, pretty much on their early open days, Tuesdays, Thursdays, they'll go ahead, take your order for you, and do the shopping for you right then, right as you get there. So it's kind of like within 30-minute pickup. 30 minutes order and pickup. It's a pretty nice service. Pretty nice service that they offered there. So let's see. Operating cash flows. So in dividends, they paid out a little bit more in dividends year over year, obviously, because they rose the dividend just a little bit by 1 cent. Share repurchases dropped quite massively. But that's not bad at all. I mean, share repurchases, it's hard to justify when the shares are so high up right now. Shares are at very high points, so, I mean, you don't expect to really be buying back shares at these levels. It's not usually logical for them to be doing that. So from Walmart US, they saw 10.5% growth year over year. Pretty nice. Let's see. So comp sales increased 10% at Walmart US. Pretty nice. E-commerce up 74%. Ooh. February comp sales grew 3.8%. And mid-March, stock-up trips caused a comp sales increase of 15.4% in March. Son of a gun. Store sales slowed during the first half of April, but re-accelerated mid-month as customer spent government stimulus money. I love that they mentioned that because it doesn't shock me at all. 100%. People are stupid with money, and that's why I don't necessarily agree with the stimulus check program. People are stupid with money, and they're just, if they're bad, people who are bad with money, it doesn't matter if you give them free money, they're going to be bad with money still. They're going to spend it. So people are going ahead and spending that stimulus check right away. And I guess that's really the point of the stimulus check for the most part. But really it's to buy essential products more as opposed to people buying just some splurge products, which a lot of people are just buying on a whim. They'll go out and say, TV, buy a TV. Why not? Yeah, wild stuff. Grocery saw a low double-digit growth. Pretty nice. Health and wellness saw a high single digit, and general merchandise saw mid single digit as well, where other companies you saw dropping down pretty massively, they benefited from it. So they saw strength in electronics, media and gaming, toys, sporting goods, and home. And again, they saw that because of the fact that every other company that sells these items was considered non-essential, so everyone had to go to Walmart. So they really benefited from that. So you'll see a decrease in that, I believe, if we're looking next quarter, because these other non-essentials are going to be opening, but they're still going to have a really good quarter in terms of those sales. I'll tell you that right now. They'll probably see more of a benefit, actually. So, Walmart International, nothing really crazy to speak about with Walmart International. Net sales increased 3.4%. Nothing crazy. Let's see. Yeah, I mean, nothing super crazy with Walmart International. I mean, I don't know. In my perspective, nothing really crazy going on there. Walmart International isn't something I'm necessarily super knowledgeable about. But you see in China, net sales increased 13.3% for Walmart International, pretty massively. That is pretty good. E-commerce sales increased by 160% in China as well. Pretty crazy. Everywhere else was, pretty normal. Canada, pretty good increase. UK, nothing exciting. From a Sam's Club perspective, you saw a 13% increase without fuel. Typically, they do the metrics without fuel. It's more important because fuel is pretty much a wash. They lose money on fuel for the most part, so not really fair. Not really fun to include that. And with prices being down so high, you expect that number to be a little bit down. Transactions. Let's see. Yeah, nothing crazy here. Pretty similar in terms of that. Not much change. Membership income, you saw a 6.4% increase, though. Pretty cool in that aspect. Comp sales increased 12%. Tobacco negatively affected, obviously, because a majority of these stores quit selling tobacco. There was Q1 strength in fresh food, grocery, consumables, health and wellness, offset by softness in apparel, tires, and jewelry. Not unexpected because they weren't selling it for the most part. Not selling any jewelry. Tire departments completely shut down just due to this. And then apparel, not many people are buying apparel right now. E-commerce sales increased 40% from Sam's Club. Pretty nice. Fresh freezer cooler was a low double-digit growth. No shocker. That includes your meat and frozen deli stuff, all that stuff. Very nice growth there. Obviously, people were buying the heck out of that stuff. Grocery and beverage, low double-digit. Consumables, low double-digit. Home and apparel was a negative, high single-digit, so not good in terms of that. TEO, technology, office, entertainment was a low single-digit. And health and wellness was a high single-digit growth. Very nice. The only other real thing we have to look at is if it gives me balance sheet. I don't think it will, so we're going to have to look for this balance sheet just real quick. Don't mind the clickety-clackety unless you want to hit this sackety. I don't know what I said, and I would like to not say it again, in my opinion. So let's let this bad boy load. Give me that earnings release, and raise the roof, baby. Here's the balance sheet that we've all been waiting for. How does the biggest retailer in the world look on a balance sheet perspective? They actually give me a year-over-year comparison, which is what I like more. Total current assets right now is $63.3 billion versus $61.7 billion last year. I'm sorry, I keep doing this quarter over quarter because every other company's doing that, but I like year-over-year. Total assets in general is $232 billion. Really 230. What is wrong with me? $232.8 billion versus $234.5 billion. A change of around $2 billion. Nothing massive there. Year over year, pretty similar. Let's look at the liability perspective. Total current liabilities of $82.6 billion, increased around $3 billion year over year. $79.8 billion last year, and total Let's see. So that leads, there's a total stockholder equity on this, if you're accounting for just total liabilities in general, of $74 billion. So they have $74 billion more assets than they do in terms of liabilities. I mean, there's no shocker in this company that's got a beautiful balance sheet. They print money like no other, added $5.3 billion in cash flow this quarter. I mean, the company knows what they're doing, and they're doing a great job of it. Really proud of this company. They're biggest retailer in the world, and they always will be. What can I say? Very happy. It's a company I own 50 shares in. Very happy to at this point because, well, the value just keeps growing, baby. So I really hope you enjoyed this. We'll talk about Home Depot next.